Hi there, I'm Mark Sebastian, founder of OptionPit.com, and this is Doubling the Dividend, how you can help your clients double their dividends. I'm going to remind you this is for education purposes only, should not be considered investment advice. Options carry risk. So, what are you going to learn? You're going to learn how options are insurance, what a call option is, how selling a call can be insurance, the characteristics of a covered call, how to double that dividend, and what a covered call campaign looks like. Options as insurance. Stocks go down. This is the number one fear of an investor. A stock I own went down, and I'll tell you, investors are great at doing that. They're great at buying tops and selling bottoms, aren't they? So how does one protect a long stock position from losing money? Well, let's look at a stock position. This is Coca-Cola. I'm buying Coca-Cola for, let's say, $45.40 here. If the stock goes up to $46.40, I make $100. The stock drops to $44.40, I lose $100. What the client is worried about is if the stock drops to $35.40 and they are out $1,000. That's when they start to get angry or annoyed or troublesome. So, what do I do about that? Well, here is a long call. In this case, I'm buying a March 44 call on Coca-Cola. So, as you can see, what have I done? I've now created a floor below $44. I am no longer losing money. Above $45.40, my break even has moved a little bit. I needed the stock to move a little bit higher. So that amount that I need the stock to move a little bit higher is that insurance value that I paid for in order to have limited downside. I'm participating in $1.48 of downside, and to pay for that, instead of all of the downside, and to pay for that, I have to make a little bit more on the upside before I hit my break even. That's that insurance cost. So the trade, buying a call instead of buying a stock creates an insurance pact. The seller of that call agrees to let the owner of the call participate in a stock's upside. In return, the buyer pays that insurance cost, that little bit of premium. So who wins? The answer is, over time, nobody. If we just trade call options back and forth and let them expire, over time, nobody really wins. So then why am I talking about this? Because what if I own the stock already? If the seller of the option owns the stock at a lower price and sells a call, how does he or she feel when the stock gets called away? And the answer is happy. Happy is what you want your clients to be. And this is what a covered call creates. In my opinion, it creates happiness. So what is a covered call? A covered call is a combination of a long stock position and a short call. The combination creates a position that can produce positive cash flow, that call income, that premium I'm collecting. It increases an investor's margin for error. Well, the more premium I collect, it's going to lower my cost basis. And then this is the most important one, and I'm going to talk about this in a little bit. It'll help the investor make sell decisions, which you may know is a problem. So let's talk about making a covered call. Here's KO. I buy my stock for $45.40. And then here is selling a call. In this case, I'm selling an April 46 call, collecting 44 cents. So notice the short call seller, it has upside risk. If KO goes off to the races, he or she is losing money. Now, let's combine them, and you get a thing of beauty. So what do I get? Well, I participate in the stock's upside all the way to $46.44. I've raised my break even. My break even is now $44.94. So I've got a lower break even and I've got upside. What's the downside of this? As you can see, above $46.44, my upside is capped. I get what we call the stock called away. So the net of the trade is we collected premium on the trade, which lowers my cost basis. I limited our upside because if the stock moves above our call strike price, our stock will be called away. But if we own the stock lower and get called away, we are happy. And this gets to those concentrated positions. So how many of you, and this is going to be a familiar story, have clients that have way too much of one holding? And you tell them, sell it, sell some, reduce some, you do something. And the client says, well, I've done well, I've done well, I've done well. And so they don't, and then eventually the stock drops and they're sad. Well, what if you were to say, hey, don't sell the stock, sell a covered call. And in doing so, I want you to create an income stream. We're going to create an income stream against your concentrated position that you need to reduce. Don't have to sell covered calls on all of it, but you can sell covered calls on some of it. And over time, if the stock gets called away, it will reduce the concentration of that holding. But there's more to that, because what if the stock doesn't rally? What if it just sits there? Well, I get to keep the dollars. Well, if I'm holding a dividend carrying stock and I'm collecting premium on it by selling calls, what am I doing? I'm collecting a lot of income. I'm doubling my dividend. Think about that. In KO, if I sold those same calls and collected about 44 to 50 cents every 2 months over a year, that's $3 in income. That is way more than Coca-Cola pays in dividend every year. Your client, if they don't get called away, may double, triple, or quadruple the income over time. They're going to be very happy. High net worth individuals, what is the one thing they like most? Income creation. This is how that can be done. So let's walk through a covered call campaign. So this is in Verizon, and I just started at the beginning of 2018, and we start on January 19th. Stock is $51.91. I sell a February 53 call. I collect 80 cents on that. The stock closes lower. So the stock loses $1.76. However, I only lose 96 cents because I collected 80 cents of call premium. In addition, I got a dividend. In February, the stock's still where it is. I sell a March 52.5 call and I collect 25 cents. If you're wondering how am I picking the strike, I'm picking the second strike out of the money. Well, the stock closes lower again. It loses $1.61. I only lose $1.36 because I collected another 25 cents of premium. We get to March and I sell an April 50 call collecting 32 cents. The stock again loses 66 cents. However, my covered call only loses 34 cents because I collected premium. April, we're now in April, the stock is $47.90. I sell a May 49 call collecting 75 cents. The stock this time basically stays where it is. It loses 16 cents. However, and this is where the teeth of the strategy comes out, I'm actually up on the month. I made 59 cents and we also collected a dividend. Then we get to May. We're trading 47.74. I sell a June 49 call, collecting 43 cents. The stock closes up. The stock made 32 cents. However, my covered call, because I collected that premium, made 75. We get to June, and we're at 48.06. I'm selling a July 50 call, collecting 20 cents. Well, I finally get the stock called away. My stock closing price is $50.62. I have to buy the call back for 62 cents. So my covered call P&L is only $2.14. My stock P&L is $2.56. But let's talk about what happens over the life of the trade. Over this period of time, my holdings made 82 cents. The stock only holdings lost $1.31. Let's not forget I also had dividends. So now let's look at what we did. My stock P&L, I lost $1.31. My covered call income was a net $2.13. My dividend income was $1.18. So my net income actually is $2. Well, I didn't quite double my dividend, right? My dividend was $1.18, but I sure as heck did a lot better. My customer collected $2 in income instead of losing money over that period of time. Even with the dividend, my stock lost enough that I lost money on this holding. My clients, I'll bet you that I consult with, would much rather make $2 than lose 13 cents. So by selling calls, the customer is a huge winner relative to just owning the stock. It's great. So as a money manager, you need to differentiate yourself. And you do this by creating a double your dividend plan for your clients, or by creating a income stream for reducing concentrated wealth. No robo-advisor is going to be able to swiftly manage your customer's book to create this. A robo-advisor is going to say, sell this, buy this. Your smart dividend doubling plan is way better than a robo-advisor. And interestingly, despite seeming simple, this is currently at the cutting edge of strategies being employed by RIAs and money managers. You would be surprised, but this is a really cutting edge strategy in money management. Leading managers all over the country are using options to produce income. If you look at the managers who are seeing AUM grow, they almost unilaterally use options. This is just the tip of the iceberg for how you can differentiate yourself from other managers. And we can show you all of the other things you can do to differentiate yourself. So what can you do? Well, you can create optimized covered call strategies. This is something we can teach you to do. You can create put selling strategies. Put selling strategies to get into stocks, put selling strategies to produce income. You can create the wheel. That's selling puts to get in, selling calls to get out. We can teach you hedging strategies, how to create global hedges over a portfolio. We can teach you stock replacement strategies, how to not even own stock and just use options. And notably, we will teach you how to deal with customers that have concentrated wealth, producing income on concentrated wealth, even if they're underwater. This is something high net worth individuals are begging for, and we're going to teach you how to do that. How are we going to teach you? Here's the next step. You're going to take Option Pit's Masterclass, Portfolio Management for Investors, Money Managers, and Investment Advisors. This is how you're going to separate yourself. Plus, if you are a certified financial planner, you're going to get 12 continuing ed hours for this 10-hour course. You need the continuing ed hours only anyway, right? So just on that. But this is something that you can use and you'll be able to employ, and it will help you grow assets because your clients will be happy. Your existing clients will want to give you more money, and they'll want to refer you. The number one way to get new clients. This is going to be taught live, but you will keep all of the recordings. All 10 sessions will be yours to review and peruse. You'll get the materials. You'll get access to ask us questions via email and in the class. This class is a steal at $997, $1,000. When it's done, we're going to list it in our store for $2,000. However, for the next 24 hours, if you use code CFP300, I will knock off an extra $300, bringing this to $697. So basically $50 a credit hour if you're a CFP. That's a steal. You can sign up for it right on the page in which you're watching this. Or if you've lost the page, it's optionpit.com/RAMaster. This course has a money-back guarantee. that if you don't learn anything that you need, we will refund you or make it right. If you've got questions, email me marketoption.com or call us 888-TRADE-01. Again, this is a must-take for any investment advisor that really wants to differentiate themselves and grow assets. Plus, you get 12 continuing ed hours if you're a certified financial planner. Thank you very much. Have a great rest of your day.